Well, good afternoon, everyone. This is Al Dominic. I'm coming to you from Washington, D.C. today, and we're just delighted to host you for really the next hour or so as we look at M&A trends that are taking place across the United States right now. This is me in better times when I put a tie on and actually could, put a suit and tie on at the same time. I'm the Chief Executive Officer of Bank Director, Director Core, and Finex Tech. Essentially, we're an information resource to the financial community designed really to connect the right people around the right ideas at the right time. And we think that this particular topic really hits the mark of being both timely and relevant. So I really appreciate the help and support of our friends from Crowe. Crowe is a firm that I think many of you know. They do work with over 1,800 financial organizations, and they just do exceptional work on the tax, advisory, and technology side. Wonderful organization that we at Bank Director have long considered great friends of ours, and it's really a pleasure of mine to welcome some of their partners to today's webinar. Now, when we think about where we are, I've got to give you a little housekeeping tips. So we have a few slides that you're going to hear me go through before we get into the conversation with Rick Childs and Mike Percy. We are, for those of you who are interested, offering CPE. This continuing professional education is something that we are able to make available if you're able to participate throughout this entire program. We have a handful of questions that you do need to answer to receive the credit. We also have Kendall Kelly, who's on our team, happy to help if there's any questions. You can see her email address below on this slide. Continuing with the housekeeping details. Most of us have now been on various Zooms, webinars, things like we're watching right now. So you probably understand and appreciate that you're in listen-only mode, which means you are muted. If you need to do anything in terms of changing the presentation, you can slide the bottom of your screen to make your size larger or smaller. If you have questions, we've got a team remotely working in Nashville, Tennessee today that is more than happy to help. Continuing on, we have just interesting amount of information to be covered in a short period of time. Once this presentation is done, all of this is going to be available on bankdirector.com and on crowe.com. As a participant, we're going to send this to you by email. You should know if there's any issues that come up. We do have a chat feature on the right where you're able to ask for help. At the same time, we are going to be putting some polling questions in front of you, so look forward to that. So housekeeping is always a fun thing to do remotely. We'll try to keep it brief, but sometimes you see our team in action in person. And a lot of folks know Bank Director as the company that hosts the Acquire or Be Acquired conference. And we've got great plans and ideas to do that again next January. We're also coming off our AOBA Summer Series, which is a special look at some of the issues that Mike, Rick, and I are going to talk about today. But I just want to anchor our webinar in the fact that we've been looking at growth catalysts like mergers for years now. And there's some really interesting statistics that we're going to be able to share that'll just jog your memory as to how we are in the place that we are at the moment. So again, that's our team under maybe sunnier circumstances. As we continue on with the slides, I brought some notes with me today, so I am going to cheat just a little bit because when we talk about M&A, we do have an annual M&A survey that is sponsored by Crowe. Again, we really appreciate what they're able to do in conjunction with us to really understand where and how financial institutions are making strategic decisions. If you think about last year's survey and maybe what we were able to accumulate, you'd see that these regional mergers of equals really dominated people's attention. At the same time, a number of participants of this particular survey anticipated a slower number of deals being done in 2020. Clearly, none of us could have expected or anticipated the freeze that we've been under for the last 6 months. But it's interesting to note that many bank boards were not necessarily thinking that 2020 M&A was going to be as robust as in previous years. And when we think back just a few years, you can look at the number of deals that were done. In 2019, there were 269. In 2018, there were 264. Pricing is something that we want to talk about. Expectation for where these mergers might occur is something we're going to talk about. But it's important to note that the consolidation trend that we were seeing over the last several years has basically been put on pause. And when it comes back is, again, a reason why we're having today's webinar. So as I mentioned, we've been doing the survey for a while with Crowe. I give them, again, a lot of credit for helping us to understand some of these key trends that we're seeing. I know we have another slide that's going to show that we've been working with them on this, but I'd really like to talk very quickly about our participants, Mike Percy and Rick Childs. Mike is the managing partner at Crowe. He is in the past been the board chair of the firm, which is the governing body of Crowe. With 30 years experience in the financial sector, we're just really pleased that he's able to share what he's seen and what he's seeing with all of us. And then his partner in crime is Rick Childs. Rick, for some of you, needs no introduction, but he too has 30 years of experience. He's the national practice leader overseeing the delivery of transaction and valuation services for the firm's clientele. And, just two smarter men I don't know that I've spent time with when it comes to some of the issues that we're going to be looking at. So that's who we're seeing. And I see Rick's popping up. Mike, maybe you want to join us as well, because I think there's going to be some great opportunities, not just to hear from them, but to see what you're thinking and ask them to respond. So as I mentioned, we're going to offer some questions up throughout this presentation. When we do, I'm going to take a pause and let both Mike and Rick respond in real time to what you're thinking. And hopefully this just keeps things not just moving, but current. So I think we've got the stage set. I think the housekeeping details can be put to the side. And at this point, if Mike wants to join Rick and myself, what we'd like to do is really break this whole presentation down into 5 parts. We want to think about, kind of where we are now in the current situation that most all organizations are facing. We want to think from a buyer standpoint, if it's appropriate to do a deal. If you're a seller, what's a realistic expectation? We want to think about credit concerns that all of us are talking about, and we also need to think about integration challenges. So that's a framework for what we're going to discuss. Again, it's a pleasure to host this webinar with all of you today. And with that, let's get things started. Well, Rick, I see you, and I'm waiting to see our friend Mike Percy.
Oh, I see him. I don't. And there he is.
If you see him and I see him, then maybe we can get things moving.
There you go.
I'm here. Hopefully the audience can see me.
Well, I like it. So we wanted to talk about current conditions, really for all parties. So I mentioned where we're coming from over the last few years. I just want to give both of you an opportunity to share your perspective on what's taking place in the financial sector right now with a specific focus on M&A. So Mike, maybe you want to kick things off for us.
Sure. As you mentioned, clearly we're just not seeing a lot of deal activity right now. Clearly prices are down. And I think that's causing, even though, to your point, the market we expect to be slow with the prices being down, I think that's delayed it even more. Clearly, we're seeing trends in the market, things like, lower for longer with interest rates, and the Fed just announcing that we're going to be in a really low interest rate environment for a while. So I expect eventually that's going to cause movement in the M&A space, even if the stock prices don't rise, because eventually people are going to say we need to manage this cost structure differently, and we need to get bigger to do it. And so that'll probably drive some M&A activity. But I think until you see stock prices change much, there's not going to be a large appetite for it fairly quickly.
Yeah. Rick, how are you feeling about things?
Yeah, I think I see it much the same way. I will say that even though we've had reasonably good numbers over the last several years, and there have been several super regionals that dominated the headlines, the vast majority of the deals were on the smaller side as we continue to see consolidation in the under $1 billion bank size. So even in 2020, the deals that have been occurring, they're continuing to follow that same path, which is substantially smaller institutions. If anything, one of the unique aspects is that with more and more acquirers sitting on the sideline because their stock is less than book value in terms of where they're trading at thanks to the pandemic, cash buyers have all of a sudden been the resurgence. And so for a number of smaller buyers, cash is the only consideration that they have available. And with rates at an all-time low for even bank loans, it has become very easy to achieve a bank holding company loan You use that to purchase a smaller institution for cash and not have the noise in the competition from larger banks with traded stocks. So it actually has provided some opportunities for buyers to have a little less of a crowded field. And I think, if anything, the pandemic has probably accelerated some of the reasons that these smaller institutions tend to look for a merger partner, which is succession planning. That has certainly put a strain on everybody. Taking care of your associates, and we know that for some institutions, they've struggled through COVID to be able to work remotely and to be able to keep their associates engaged. And then just in general, there's no doubt that a number of shareholders actually would need cash because of tapping into the reserves. So there are, I think, some reasons why that you'll continue to see sellers decide now is the time to exit. But then I think there'll be others that will hold out until the stock market comes back. We aren't seeing true mergers of equals like we did with some of the large regionals that occurred in the last several years, or some of the blockbuster deals, but we are seeing some unique mergers of equals where I think the primary cause for coming together is scale in some cases, or in a few cases there have been at least one or two transactions where it truly is a niche purchase, and it just so happened to, at least if you announce it as a merger of equals or something similar to merger of equals, you can get by without paying a large premium or feeling like bad about accepting a small premium if you're the seller. And so that has, I think, played out in 2020 as well.
Yeah. Well, let's talk a little bit more about just the current conditions, and I'm thinking about valuations and kind of what's been done to banks on both the public and private side. When you think about the market has rewarded growth stocks, which banks are not considered. So, that you look at like the KBWs, like KBX index, you see bank stocks lagging the field, even though, after the triple P, I think most people in the industry would say there's some good performance, at least that, in the short term would be normally rewarded. Where do you see the valuations of banks right now relative to how you thought they would have been coming into the year? And then maybe we can take that as a future projection of where do you think valuations might be heading?
Well, the prices, to be kind, in April and March fell off the face of the earth. That is kind of the way it happened. And so there was a dramatic drop down in there. Now, leading up to the announcement of the pandemic in, say, mid-March, already bank stocks were starting to fall down as a result of the margin pressure that was occurring, as well as, I think, some general expectation of Q1 being unique with regards to the implementation of CECL for a number of the public institutions. So stock prices were already starting to lag a little bit before the announcement of the pandemic, but after that, and with the emergency drop in interest rates, they went down significantly, even with the announcement that there would be triple P loans available, as well as the Main Street lending program that came out of the variety of the stimulus packages. It really, I think the expectations were that there'd be significant credit issues, there would be significant margin pressures, and then we would have additionally some expenses. So we're down, we've recovered nicely since that low point. We're still, I think, in general, as an industry, below book value in terms of the price to book, but we've come back nicely to that. I think the recent announcement is probably going to solidify that we'll be in a relatively low valuation for a while now. The one thing that I think that the analysts are struggling with a little bit is understanding the impact of CECL. So if you understand CECL, it is build today for losses tomorrow, significantly more so than you ever did during an incurred loss model kind of thing. So in quarter one, quarter two, as well as the day one build, these banks put in significant amounts of reserves in anticipation of what the impact will be down the road. Now, they were based heavily off of several economic models, Moody's and Oxford being the primary ones there. But we're seeing that those may not be as dire as they were and continue, both of them refine their announcements. And so there actually is some talk about will there be releases of reserves in Q3. I myself don't think that'll occur. I'm sure that there will be some that will, just because they're following the letter of GAAP. But the reality is that I think they're going to wait and hold off until they see where their losses are at. But it's probably unlikely, unless something occurs here in the next couple of weeks, that we'll see significantly larger builds of the allowance for loan loss from a CECL standpoint. We may still see incurred loss. So I think that has sort of helped depress the model. We'll find out when the actual delinquencies and losses start to roll in, maybe towards the end of the year. Certainly in the first half of 2021 is when we might see that. And I think that will continue to be a headwind on prices. So I expect that the values will be down for a substantial period of time.
Yeah, and I mean, as everyone jokes about 2020 and their memes and GIFs, I mean, to toss CECL into the mix this year, just, it's one of those shake your heads of all the years that this could happen. So as I'm thinking about the year that we're in right now, we've got an election in November. It's got people thinking about regulatory expectations, maybe not any other adjective I can put against that. I'm not sure if Mike wants to handle this or if you do, Rick, but let's talk a little bit about regulatory expectations at the moment when it comes to a transaction. Anything that a board in particular needs to be aware of?
Well, I think, and Mike, I'll let you talk a little bit about this. I think you should anticipate there will be a heightened level of scrutiny on your application and on your due diligence in particular. How robust was your due diligence? That will be, I think, the norm in terms of any applications you would make for an application for doing an acquisition. But I mean, I think, Mike, you can talk about what we're seeing just in general from our regulatory, and then you add into that 2 new programs that came out, although one really isn't being used as much, the Main Street lending. But from the PPP standpoint, it came out in a hurry, it got implemented in a hurry, and we're still waiting for some guidance or whether there'll be even another round of it. So you might talk a little bit about that, Mike, from kind of what we're seeing in our clients, because I know you've been really deep into working with our clients on the PPP loan program.
Sure. Just to broadly speak about the regulatory environment, then I'll talk about PPP. But I would say this year, I think the industry is experienced what I'll call a lighter touch. Now, if you're being touched, it never feels light, but in general, the regulatory environment just hasn't been as heavy. And so I think there is, fear around, what could be the impact of change from a November election, and could that cause the regulatory winds to change a bit? And so, and clearly none of us know, but I think that clearly is out there. But because in general, I think people have felt a bit of, again, kind of maybe just a lighter touch this year than in many years in the past. And then as it relates to PPP, again, it feels like the political winds may drive this a bit as well. Seeing things coming out of Congress, both sides relative to, how's the administration doing around this program, with the House being maybe a little more critical around concern that maybe there's a decent level of fraud that occurred in the origination. So if in reality, I think most banks, they loaned to their customers for the most part. And so kind of your AML systems, your customer probably identified, anything unusual up front. And then in the forgiveness, again, I think people's AML systems will identify some unusual payouts and flag things. But that is an area where there's a lot of uncertainty relative to regulatory. And it may not be the normal regulator, right? It could be, the SBA versus your prudential regulators. But prudential regulators could be looking at it too, relative to what have you done from a risk management standpoint. And there's a little bit of, from an operational risk standpoint, the perfect storm. Anytime we have real large volumes in really short time frames, that's where operational risk happens. You go back a decade and the foreclosure crisis we had, we all knew how to foreclose on a loan. The issue was volume and speed, right? And so that's a bit of what we had with PPP as well. I'll say banks did yeoman's effort getting systems set up, getting after it, giving good client experience, especially in the second rounds. The first rounds was a little more challenging as no one kind of understood how to even get things through the process. But I think as things shake out, we'll identify maybe where there was some risk that came out of that people just didn't identify going in up front.
Yeah. Well,
now I would say one other thing about that, without betting on horses, so to speak, but let's put it this way. If there is a change in administration in November, and with some of the speculated Secretary of the Treasuries that have been put out there, my anticipation is that it would not bode well for bank acquisitions in general. Just based upon the rhetoric you see coming out of Congress from congressmen and women and from senators who are describing sort of things as simple as buybacks as being evil, in which case they somehow don't understand that capital is not the U.S. government's money, it is the shareholders' money, and they're entitled to have it back, but that they believe buybacks are an evil thing. Well, they must also think that acquisitions are an evil thing, unless cynically it comes from a large donor, in which case the acquisition is probably okay then. But you'll see that, and I don't think that will necessarily help on the transactions. They can't prohibit the transactions, obviously. There still needs to be consolidation. I think that is the general view of the regulators, that the continued consolidation would be good for the industry. But I do think that it'll become more difficult, and I think it'll slow down the transactions. And if there's even a hint of anything wrong with sort of the hot buttons, so CRA, with anti-money laundering and BSA, with consumer compliance primarily, so CFPB type of issues, fair lending being a great example of that. I would anticipate it being difficult to actually do that transaction. So you're going to not be able to buy a scratch and dent bank, so to speak, when it comes to those hot button issues. You're going to have to look for those that are pristine. And since we're all human, run by humans, we're all going to make a mistake. There's always going to be a reason why something's let down. And so if they're looking for the aha, they'll find it, because that's just what happens. And I think it could be detrimental to bank M&A in general, just from the regulatory approval process.
Yeah. Well, I don't want to encourage gambling, because, that wouldn't be right, especially around like the US Open's coming up this weekend. Like nobody's going to be gambling on anything, sports related. So we should never gamble on business issues. But maybe if we were to become prognosticators and take out our crystal ball, this would be a great opportunity to ask the attendees that are watching if they could help us with a few questions so we can understand where they think the market might be moving. So it's not just, the three of our opinions. So we've got a question that basically feeds off of what Mike and Rick just were talking about. It's all around bank M&A and, when will the normal levels that we've seen in the past few years come back? So I'm hoping we can put this question up so that we can ask the attendees to weigh in, because we really do want to hear, without gambling any money, what could actually come to pass. So let's see what you guys think. The first question again, when will bank M&A return to the normal levels of maybe 2018 and 2019?
Well, the answers so far are interesting, which is not next year. Oh, there's a brave soul.
Well, so what are we thinking, Rick? Is it 2021, 2022? They'll never return? You prefer something organic? How would you answer this particular question?
Right now, I think the answer is probably going to be, I actually think I'm going to straddle it, which is I'm not sure it's going to, for the 12 months that sort of center around June 30th, 2022 through June 30th, 2023, that's when I think you'll see kind of a normalized return. So I'm probably betting fully in 2023. It will be okay in 2022, I think, absent some other significant shock like a change in administration or something else that occurs. But I'm guessing that 2023 will be when we see a full year of robust. It wouldn't surprise me in 2022 to see for the second half of the year to be on a more normalized pace as well.
Okay. Any surprise that nobody prefers organic growth of the group? Kind of a trick question. We just wanted to put a fifth one in to see if we get anyone to bite.
That's right. Well, it is a little bit of a trick question. And the other thing, too, is it's really hard to define what organic growth is, because all of our balance sheets have been ballooned by. So, that was the interesting phenomenon, Mike, you might talk about, is what happened with the actual PPP loan money that was received. We made a lot of money, but where did it all go? Because it certainly didn't always seem to go out of the bank.
Yeah, it's interesting, the whole liquidity issue where deposits have really inflated. At first, people drew on their lines of credit and they left in the bank, and then with the PPP, Most banks actually require the customer to open up a deposit account. And again, a lot of that stay in the bank. Now, it doesn't mean they didn't spend the money as they were supposed to for forgiveness and on payroll. It's just, cash is fungible. So whether they pulled out of that account or not is the issue. But we have not seen a lot of deposit outflow at this point as savings rates continue to be pretty high.
So it's kind of really hard to determine what is quote organic growth because we got a lot of monopoly money floating in the bank right now. Not the least of which is we had for the first 2 quarters we had tax payments that weren't paid out until early July. So if you look at the first 2 quarters of call reports, it had a significant amount of tax deposits in there waiting to be spent, as well as PPP money, as well as loan deferrals, all ballooned the deposit side. Plus, then we added a fair amount of loans on the asset side. And so I've got a few folks thinking about capital raise purely for the purpose of being able to make sure that by year end, they're in a pretty good condition because they don't anticipate that their PPP loans will be paid back by then because we actually don't have significant guidance yet. And some of the institutions are planning on keeping, some of the companies are planning on keeping their loans as a cheap insurance policy at 1%. Not a bad way to fund your operations. So.
Yeah. Well, so I like the first poll question because it lets us look backwards. The next one is designed to look ahead. So, if we could put this one up, this is all around, if you're currently engaged in M&A talks, whether, you're as a buyer or a seller, we're just asking, have you been engaged? And we're giving you, 4 potential answers. So we are, or it's a much longer time frame. So let's see what the results look like here. All right, so as we wrap up this, some people are changing their minds, it appears. But when we think about, are you currently engaged in M&A talks, either as a buyer or a seller, we have not been at least as 50% is how it looks right now. And I think that's important because some of the presentation that we want to look at really talks about, a deal both from a buyer standpoint, but also from a seller's, because you've got to find that sweet spot of marriage. You've got the cultural issues, you've got the opportunities that are potentially available, but you also need to understand when you're doing a transaction, you're either investing somebody else or you're cashing out of the industry. And I kind of like this as a midway point in the webinar, simply because it's giving people a chance to share where their interests might potentially be. So that, Mike and Rick, helps, I hope, us orient ourselves around these next few questions. So I'd like to, kind of keep things moving. Again, taking it from a seller's perspective, what are some of the greatest challenges in successfully staging an exit right now?
Well, I think for a potential exit is setting the expectation of your board members as representatives of the shareholders for what the price realistically will be. And really evaluating whether today is the right time to buy or to sell, or should we continue to hold on, and what are the factors that are focused in on that from that standpoint. If we're receiving shares of stock in the transaction, the other thing that sellers, I think, need to give some consideration to is significant amount of due diligence on the buyer from an investment perspective. So you're making a significant investment, which may also lead you to saying, based upon where our shareholders are at, the best solution for us is cash because it allows them to diversify and provide liquidity that may be much needed in today's environment. So I think as they think through those transactions, they've got to look at it from that aspect of it. And then I think they've got to figure out how do they help the buyer with due diligence in what is effectively for many institutions a virtual environment. Now, due diligence has moved substantially to virtual over the years, but you still like to touch and feel the management team. And while you can do a lot of things through Zoom, sometimes it's really good to be in a room together and read facial expressions, which, by the way, if you're in a room together, it'd be awful hard to read facial expressions behind your COVID mask. So you better be really good at reading facial eyes, and lots of good exercises there. But I think that they really have to evaluate what's driving them, and what is the benefit of coming together on a transaction like this. Now, I think it does allow them maybe to pick and choose a little better on who the buyer is, because there won't be as many. And because you've got now cash buyers that are probably a little closer to their size and maybe a little friendlier with regards to how the associates and their customers are treated, you may take that into consideration and find this to be an appropriate time. But realize that if you're getting a cash deal, there's no upside for you. It's cashing out today with $1 in the hand and looking at that standpoint. So, I mean, I think a number of people will look at this as either wanting to extend the time of the deal out, continue to have conversations, but extend it out so with hope that we'll get back to a more normalized valuation scenario by the time you'd like to do the transaction.
Well, and Rick, as you're saying that, maybe Mike could help, so if you're sitting in the boardroom and you think, okay, now's the time to actively consider, what's next for our organization, how do you look at pricing and have realistic expectations? I mean, you can have your ambition and your aspirations, but just because somebody has some cash in their pocket doesn't mean it's all going into yours. So how do you set that responsible level of expectation?
Yeah, well, I mean, as a seller, you can flip and say, well, as a buyer, what would we be? Where would we be concerned? How would we probably be pricing, and what would our expectations be? And then realize that's the expectations on the other side of the table, right? So, as you think about, as a buyer, I would probably be concerned about, can I really understand the credit issues? So, as a seller, I need to make certain that I can articulate that well. Same thing from a consumer compliance standpoint. My comment earlier about the regulators having a lighter touch, in normal regulatory times, there's a level of due diligence where you can gain reliance on the regulators kind of kicking the consumer compliance tires. So if it's a little lighter now, maybe you've got some undisclosed risk there you wouldn't otherwise have. The other thing as a seller, I would be thinking about things like what's been valuable to me, but that is not going to be valuable to a buyer. Things like long-term IS contracts that, and people have been making some technology spend lately. So, but how many of those are long-term deals that are not going to be as valuable to the buyer that are going to be hangups in this deal? So, I think some of it's just kind of self-analysis of what you would do if you were the buyer.
Well, and Mike, as you're saying that, I'm looking at a question that just came to us, and it's about bank purchases getting more difficult. So, what's the outlook for branch purchases?
Really good, actually. Surprisingly, we've seen a number of branch transactions pop up this year. And so I think that there are many institutions that are relooking in this environment. So if you think about our dramatic switch to digital banking that occurred in the last 6 months or so, we have, as it says, we want 10 years and 6 months effectively in terms of our digital adoption. And so many institutions are reevaluating where their branch structure is at. And so we've seen an even reasonably decent sized organization doing onesie twosie flip offs of branches, as opposed to, you think back several years ago to when Bank of America did significant branch rationalizations. I've seen several larger institutions that have done a sale of 2 or 3 branches here and being willing to do multiple transactions, where in the past when everybody is, so to speak, fat and happy, many of these large banks don't desire to do any singular type transactions, and now we're actually seeing some of these institutions willing to do bundling up 2, bundling up 3, maybe doing 3 or 4 transactions in a row as they go through the branch rationalization. And so it really has been a good opportunity to purchase for a number of institutions, and pretty affordable, I will say, in terms of the size of the institution for many of the acquirers. And so it really gets down to, you may be the best operator of that branch compared to anybody else, and so it's a really good opportunity for you.
Yeah, well, we got
to. I was just going to Rick's point about being affordable. I mean, because you're seeing more branch closures recently than you have in a long time. So that's part of the seller decision of what's the right thing for me to do, close it or sell it. So I think that's helping with the pricing.
Yeah. Anecdotally, it's interesting to watch JP Morgan drop branches into major metropolitan areas at a time when others are trying to figure out what they want to do with their branch network. So I think this is one of those issues that's been discussed for years, and it's probably going to continue to be discussed. But what you
But you also notice there's a lot of technology and fewer people in those branches.
Oh yeah, it's not your old school branch with lollipops and pens tethered to the table. But you guys, I give you credit because you've sparked another question, which lets us pivot from the seller's perspective over to the buyer. So we have a question about buyers and what do they value now in a target, and by extension, has that changed in the current environment? So again, it's a two-part question, but what do buyers value in a target, and has that changed given our current conditions?
Yeah, I think it has changed a little bit, but I suspect it's a little bit more of a knee jerk, which is to say, substantially over a period of time, we've had this question on our surveys with you, and deposit basis have always been I think one of the primary driver, plus the talent aspect of that, or at least access to a fresh market that I'm not in already. Lending at times has not been nearly as highly rated. It's not to say that it's not desired, but I think it's always been more of a deposit relationship that they focused in on, as well as talents, because I could always find a lift out of a lending team and take my own, or at least provide my own resources on that aspect of it. Deposits right today is not a problem. And so I think we're still looking at long-term deposit franchises, but I don't know that we're paying significant premiums to get those franchises, because one of the issues we have is we just purely have a capital issue in the short run. So as a knee jerk, I think this year we're looking at it and saying that, deposits, yes, we're interested in long-term from that standpoint, but we're not overly going to pay for it because we got plenty of access. Loans are the real key here. Trying to identify what is core loans, what might be sticky on PPP loans that we made outside of the bank, how much of those relationships. And I've heard anecdotally a number of bankers very optimistic about their ability to be able to retain those accounts long term, which will be, I think, beneficial. And then obviously a significant dive into the credit quality. I suspect on the deals that I'm working on right now, we will spend 4, maybe 5 times the amount of energy and effort on the loan portfolio. So if you look at any of the disclosures and any of the investor decks from some of the public companies, you can see that they have a very manual process towards getting deep, granular into their accounts. They're having loan officers make significant amount of calls. It's good. It's a great way to reestablish connections with your loan customers and dive into it, but understanding very minute details about that. And so I think from the buyers that I'm working with, we're doing the same thing. We're diving deeply into every level of the portfolio and trying to understand just how much at risk it is, and not just taking the very simplified things. So for example, do you have retail? Do you have hotel and leisure? Do you have those? We can look at that, but you have to really dive down to find out what kind of hotel loans you have and where they're at geographically. So that's going to be the thing that I think we care about the most right now as we think about it. It's not that the other things have sort of fallen totally away. It's just they're not as front burner as understanding credit quality.
Well, we're going to come back to credit in a moment. I want to be respectful of the attendees because I got a question as you were talking, which kind of straddles the line of being a buyer or a seller. So I'll put it to you from, I'm looking to buy some branches. If I'm selling them, is there a premium that I'm getting? What would it be?
The premiums have varied, but in general, they've been coming back up from where they've been in the prior years. I think they'll go back down now as a result of the interest rate environment. But we had started to creep up close to the 6% range on 6% range on the premium on the deposits. I think that will fall back down probably 4% range, maybe even 3%, because it's just the amount of money we can make on that's going to be difficult. I will say this though, and you would rarely ever see me advocate for overpaying, but I will tell you that if you're doing a singular branch that's say 25 million in deposits, you could pay 3 and you could pay 6, and the difference isn't going to be material to probably your overall organization. And so if it takes it to get it, and that's the only opportunity you foresee having, I'd be as opportunistic as I can be. But I mean, I do think that will come down, and then also the mix. So if your branch is a certificate of deposit branch and not significantly high in core accounts, then I think that tends to augur for lower rates in general for the premiums that you would pay.
I'm kind of curious to, again, get your perspective, to get Mike's perspective. If I'm a buyer and I'm hearing all of this information, why don't I just wait? Why don't I wait, another 6 months to see if, pricing continues to, to fluctuate. Maybe it's a little even more depressed. Wait to see until after the election, what's happened. What's in it for me to do a deal now as opposed to, keeping some, tinder in the pocket, so to speak.
I'll start and you
Yeah.
can jump in, Rick. I was going to say based on the earlier survey results, I think everyone's telling you they are going to wait. so it's basically why not? But I think it would be, why would you do something now as opposed to waiting? Because waiting makes a lot of sense. I think it's more about, is there something that would allow you to advance your strategy differently? Could you do an acquisition that gets you in a market you want to be in a top 3 position, and I think later on the field's going to be crowded and I'm not going to be able to get that deal done. So I would think if there's things that are really advancing your long-term strategy, that might break over the momentum of why do it now versus why wait. But because to Rick's point earlier, you're going to probably do more diligence now because there's going to feel more uncertainty in a target than there will be in the future.
Rick, you want to add to that?
Yeah, I think from the buyer's perspective, in terms of looking at a potential deal, unless you are one of the large regionals that has significantly traded stock, now would be the time to buy, because until somebody devalues our currency, a buck of cash is always worth a buck of cash. A buck of stock isn't always worth a buck of stock 6 months from now. So I think you are at an advantage, as Mike says, to a less crowded field, and I'm going to probably find the transaction at a more reasonable price than I would, say, a year ago. At this time, we would have had significantly higher prices, and so I can acquire both and be able to achieve that. The other thing is, I think you can play a middle-of-the-road strategy as well, which is that I've got a couple of different deals that I struck around the time of mid-March with sort of some preliminary letters of intent, non-binding. And in both of those, we set extremely long due diligence periods. So call it April 1, and with the anticipation that it would run through maybe early September and maybe be extendable by agreement for another few months. Well, that was back when we thought the pandemic might be a month or two, and now that we know it's not going to be that at all, I've got both of those where we've continued to extend that with new letters of intent, but with extremely long periods on them as well. And the seller's perspective is that they like being in negotiation and discussion with us, and that they hope as this long period fleshes out that their earnings will come back to a certain level, which might justify the price that they're hoping for. And on our end, we like being able to continue to tie them up. And so the more time that they invest with us, the more likely it is that they'll go ahead with the transaction with us and not reshop it at some point in time in the future. So if we can get to that, I think it's a great time to buy. I think there's some great bargains to be had out there. And again, I think you'll find willing sellers at least considering it, because there's something driving their desire to sell that is probably a bit of an extended version of what we normally see, but maybe heightened by the fact the pandemic is here. Not the least of which is, as we know, many banks choose to sell because the management teams and the boards are weary of banking because of all the things that we've had to go through in the last 10, 12 years. The pandemic has certainly not improved that view of how it is. Now we're just weary in general, and banking is secondary to that. So I think it would be a great time to buy.
Well, let's see if people agree or disagree. This is kind of like a point-counterpoint type question. As we take our third poll of the audience, I think this is nice because it talks about the factors or risks that you want to consider when deciding to acquire a target. And so, again, we're giving you a few different options, but it's credit quality, it's the cost of the deal, it could be the cultural fit, customer loyalty, or even just the capacity to integrate. So, those are all important, but what kind of comes to the top of your list is what we're asking attendees to weigh in on. So let's give you all just a moment. It lets Mike and Rick take a breath because I'm going to ask them to help me digest the results of this once we start to see them. And so, Rick, as this poll kind of winds down, credit quality is not a surprise. I mean, credit concerns, are so prevalent and real right now. Can you speak a little bit about, just where we are in the credit cycle? And then are there other risk factors that boards need to be thinking about at the moment?
Well, it feels to me like we're in the eye of the storm, right? So it's pretty calm right now, primarily because we've had some at least good data for many of the institutions from about mid-July when the first deferrals ended, and we'll see where those are at. There were some promising signs early on that the second deferrals were down. There weren't as many requests for those. Unfortunately, for many of those asking for deferrals, I think granting second deferrals were also down as well, or at least the amount of approvals needed to get that was, I wouldn't call it onerous, but it was certainly, as one person said, we were handing out deferrals like candy on the street corner because that's what the regulators told us to do. Now in the second set of deferrals, they're asking for a significant amount for underwriting from that standpoint. So I think we're in that because we haven't quite seen some of the things that have occurred on the deferral. We're seeing good signs in the economy between unemployment being as low as it is for where it had, where we hit the bottom to where we come back to. Retail sales are looking strong, still up for the fourth month in a row. And we're obviously, with low interest rates being promised for a fairly long period of time, the economy has some real positive signs that could continue to be there, which would help us on the credit quality significantly. But what we don't know is what will happen when we get down to more of the fourth quarter when we should be paying these PPP loans back, or at least asking for forgiveness. And we'll see what the impact is of some of these institutions some of these companies that were holding on, particularly in the food and beverage industry, retail. Even though we've had strong, there certainly have been some companies that have been hurt by the pandemic. And so we're likely to see that start occurring more in the latter part of the fourth quarter. Probably December is when we'll see it significantly, and then Q1 will be probably the true telling. So I think we're not in a bad spot necessarily, and we certainly have built the provision up for that. So the allowance, I think, is in really good shape for that. But what we don't know is what will happen to the loss of income from those loans if they go bad, and then what the impact, the cascading impact of that will be on businesses that relied upon those businesses for some reason.
Yeah, and Rick, I like that eye of the storm imagery that you use, because it does feel like, there's a hurricane up brewing, and we're kind of sitting there with the pressure, and we know from experience that, we have something ahead of us. It's just, what's it going to be? Now, right. I want to take this over to Mike, because the second most represented answer is cultural fit, which isn't surprising because when you think M&A deals, and I can't tell you how many CEOs or chairmen who said the number one issue for us was the fit, the cultural fit. And we got a question, as Rick was talking about, the extended due diligence process and what impact that might have on cultural issues. And the example was, sellers' talent would be exposed to leaving.
Right.
Can you talk a little bit about culture fit today? Because, we've all been working from home, and I think people are realizing their culture might be different from what they thought it was 6 months ago.
I agree. And it's more of an unknown now. It was interesting to watch the poll results come in because it was like 100% credit at first with on cultural. So I was glad to see cultural fit made a comeback in the poll, because I think it's usually the number one reason you don't do a deal, right? Is cultural fit is a reason not to do it. So if you're doing the deal, you're feeling pretty good about your cultural fit, and it's also probably one of the number one factors in actually achieving, the accretion, the cost saves that were expected, that the cultural fit actually pulls that off. So I agree. I think it's more challenging now, and I think it's mostly because it feels unknown. There's been a strong swing to doing work remote. You're seeing things come back. Jamie Dimon just had an article today about being concerned about people being away, and especially our younger workers, and how are they going to continue to fit to our culture. So I think early on, there was kind of this pendulum of, hey, people are being pretty efficient working remotely. There's something to this. Maybe we'll just keep doing that. I think as this turns into a 6-month pandemic versus a 3-month pandemic, and who knows how long it ultimately is, the pendulum's starting to come back. And so it does feel like a bigger risk now, but I think we'll get back to something that feels maybe not what it was, but a little more normal. And so people can continue to dictate their culture and people will fit in. Even when you think of things like credit, going into a kind of an unknown cycle, that does feel like a higher risk of, what's the institutional knowledge around some of these credits that we could lose when we lose talent in an acquisition. So, it's just another credit risk in the whole deal. But I think it's the right thing to be concerned about. But I believe the pendulum will come back, and I think people will continue to focus on cultural fit as being key to making the integration work.
Yeah, and
the other side of the coin to that, Mike, is that it's not a great job market to switch jobs in. So the ability to retain people post-deal may be a little stronger for a period of time. It won't be for forever, but I think, at least be skittish to leave. And then the other thing I think about is we just had a great experiment in understanding your culture by seeing how well you, as the target, did in managing your employees in the work-at-home environment, and what did you do, and you can compare that to how you, as the buyer, did that, and you can match up. That seems a lot like what we did. That sounds good. That gives. There's one thing to say it, and we actually have the doing it part of it, and now we actually can see insights into how you managed it and give us some feeling about whether you're a good fit or not.
Yeah. Now, we've only got a few minutes left, so I'm going to encourage anyone in the audience who has some questions to send them in so we can do our best to respond. But as we talk culture, one of the interesting, we're talking anecdotes earlier and things that we're seeing. What strikes me about the SBA's PPP program is it allowed so many financial institutions who were afraid of technology to understand they could embrace it far faster and far more effectively. And when you line that up with why people cite an M&A transaction, SunTrust and BB&T is a perfect example. What did they want to do? Rationalize expense so they could invest in technology. Well, all of a sudden, if you're a bank that thought we're so far behind, we don't have the ability to compete, and then you just spent 6 months seeing, wait, we can remotely work. We can take a fintech company like Enumerated, and actually work with them to get the PPP working. Maybe we're not as far behind as we thought. Maybe we don't need to think about selling because we're technologically, lagging. Maybe we just could rethink things. Do you think that type of, cultural mindset is going to impact deals, or do you think it might, in fact, encourage them to look for a different type of partner because they would think that technology is now a little bit more attainable?
I think it will continue in influence deals, because I agree with you. I think people almost surprise themselves on how fast they could get things done and what they could kind of do themselves or with a fintech partner. But I also think it was also recognition of this is the journey we've got to be on, and we've got to be on it now. So I don't feel like it's job accomplished. I think it was more, we need to do this. We understand it better than we did before, and we have a clearer picture of where we need to go. And if you look at surveys of the roadmap around this, most organizations will, by 2024, they feel like they need to be there. They're in 2021 and 2022. So I think people now see themselves on the journey more than a journey they needed to take. But it's still a journey that's going to take a while. So I could see that being a key factor in looking at acquisition targets of what does that do together to advance pulling that off.
Yeah. But a lot of times, I think to that point, the unknown is what keeps a lot of people from doing things. We are forced into the known now of having to adapt to this. And to your point, Al, which I think is spot on, we had to adapt to this, and all of a sudden it's like, we can't do this after all. So I think, it's like the first time you try something, it's a little scary, and it sometimes can block you from doing things. But after you've done it for the first time, it's like, oh, I can do this. And so you're a lot, I think, more open to doing that, which may actually cause some sellers to consider, can we be competitive through partnership?
Yeah.
And
Well,
going that route.
So this is going to be my last question to you guys, and admittedly it was asked to me, and I didn't feel comfortable saying yes or no. But the fintech community has seen historic, valuations much higher than banks. But I think we've also seen, like, as the tide comes out, there's certain tech companies that aren't as attractive maybe as they were last year, and we've seen it with some of the deals that have taken place. MasterCard, Visa, they have big premiums that they're proud to talk about. And there's other companies that were sold like at a fire sale price. Do you think that certain banks, and I think you'd have to be of a certain asset size and a type of leadership mindset, are going to start to look at the fintech universe a little differently and think maybe we want to, lift out a team or just buy a fintech instead of letting it be white labeled by 15 of our competitors? Again, yes. I didn't have an answer for this, but I thought maybe you guys would.
Yes, I think the answer is yes. But I think the key is somewhat about size, but I think your second point was the one that's more, to me, dead on, which is you have to have the management team, the board, whose focus is to have significant fintech as a part of their strategy to do that. If you want it to, if you're more mainstream, I think, and that's your focus, you'll view fintech partnerships more as a service and less as a strategic alternative. But and we can think of the companies that are that way from the banking standpoint, where they're at times more fintech than they are bank, where the banking is a means to fund the fintech things that they're doing. I think that they'll continue to view that as ways, and that might draw more people into it. The other thing is that what a great time to buy fintech. If you think about what purchase accounting would allow you to do, fair value adjustment under ASC 805, it would allow you to effectively mark the loans to market, including how bad you think they are from a credit standpoint. And for those loans that are normally performing, you can put a fairly robust credit mark attached to it and accrete that into income. What a beautiful time to buy a franchise. We saw institutions that were flying high at 12/31/2019 lose almost all of their market value because what don't they have? They don't have a funding source. Their funding source is equity, right? And that's really not a long-term sustainable funding source, no matter what people tell you. At some point in time, you have to pay the piper with profitability and others. And so there have been some excellent purchases so far. And even Amex's latest purchase is one that's even more interesting because effectively what they did was they bought the technology and the key people related to that, but they're not buying any of the loans. So if you really don't want to deal with the loan portfolio, leave that for the seller, take the technology and the team, and it's an excellent time to do that.
And I think you're referring to the acquisition of Kabbage.
Yep. Yeah. Exactly.
I thought fintech, but again, I like to, with accountants in particular, I state my assumptions. Right. So guys, we're up on time. So I do want to say thanks to you both. I know taking an hour out of your day, might be a little easier when you're working remotely, but it's still an hour out of your day. We appreciate your time. We appreciate your thoughts. Again, we're going to be sharing this recorded session about this time tomorrow. We're going to make sure that this is available so you can watch it on demand, bankdirector.com and crow.com. My thanks to Mike Percy, my thanks to Rick Childs, and really my thanks to everyone who took the time to join us today. Thanks so much.